All right, well, welcome everybody to the July 2012 session of the Roundtable. This month we're going to once again spend some time in a bit of a tribute to our friends across the Great Pond. And you can see there the opening ceremony fireworks from the Olympics just a few days ago. I imagine many of you, in fact some of you have actually confessed that you're watching the Olympics and us at the same time, but we just wanted to give an Olympic style welcome to everybody, especially the newcomers in the room. Again, just to reintroduce all of us, on the left is Ken Kavula, our host for tonight. Cy Lynch is down there in the yellow Olympic hoop. Hugh McManus wearing his green, we can't get the green hat off of him, so he's down there in the green tux and the green hat, and myself there on the far right. So let's go ahead and get started. And again, welcome everybody. Let's get the official legal business out of the way first. And the only thing you need to know is no investment recommendation is intended. We'll talk about real companies, real time. We may share that we hold shares companies. We may forget to do that in the heat of battle, but in the spirit of everything done around here is for education and demonstration. So please honor that. Do your own homework. I think I'll set the table for a little bit and give you an idea of the agenda. We're going to talk a little bit about where we've been. We want to spend a special moment. Again, I want to give a shout out and a thanks to my three colleagues. We've been doing this for 2 years now. So we want to take a look back at where we started 2 years ago as part of the session tonight, and then just kind of take a look at the overall. And then we'll go into a series of 4 relatively brief stock presentations on the 4 companies shown there. Staples, Microsoft, and AFLAC will be repeat selections for us. So that might shorten those up a little bit. And then I actually have a brand new company that's been showing up fairly high on many of our screening results. And then we'll go ahead and poll the audience, if that's okay with Ken, to make a selection from among those 4 towards the end of the session, if we have time to do that. And the audience has such a good track record, we like to do that whenever we can. Just as a quick reminder, and I really mean quick reminder, we did start this 2 years ago with, we're fairly serious about attempting to identify companies of interest that have a high enough potential that we really think they're worthy of study and for consideration as to whether or not they might fit within our portfolios. We are willing to get a bit playful with some selections from time to time. My colleagues here will probably suggest that I've been a little too playful occasionally with a selection or 2 or 3, maybe 4. But what we're really trying to do is, again, when you add it all up, when you take a look at the collective performance, very much like any investment club or any individual's portfolio out there, we'd really like to try to build a set of companies that outperform the market benchmark by 5% over the long term. We tend to benchmark against the total stock market as measured by the Wilshire 5000 benchmark. And again, for clarity, that's 500 basis points per year. We think it's achievable. We think it's a noble objective. We'd obviously be happy if we got anywhere between 0 and 500 basis points, but that is the objective. And then our other goal is that we really would like for 60 to 70% of the selections that we make to outperform the market after we identify them and select them here. So that's part of what we're trying to accomplish. So with that, let's go ahead and take a look back at 2 years ago. You can see we were a little less formal then. There's the Knights. And at that session 2 years ago, we actually made some pretty good selections, even though they were all from healthcare at that time. Again, this is our first session ever. And you can see that the 4 of us selected Abbott Labs, Eli Lilly, Stryker, and BioReference Labs. Now, they've all actually done quite well, as you can see by the scoreboard at the bottom of the page there. Let me go ahead and pull up the Madden pen, in case we want to highlight anything here. And you can see that at the time of selection, these were all look pretty good in terms of, you know, all of the characteristics of the companies. But when you take a look at the quality ratings, they're all excellent companies with projected annual returns anywhere from in the high teens to the low 20s, as you can see there on the right. At the time of that particular session, again, 2 years ago, July 2010, the median projected return for all the companies that we follow was approximately 10%. So you can see that we were basically selecting a bunch of companies that were had a few percentage points advantage when it came to their return forecasts at the time. Well, since that point in time, the market has actually turned in a 12% annualized performance, as you can see down there in the scorecard. You can see that all 4 selections have managed to generate positive returns, some of them a little steadier than others. Others, like BioReference Labs, was quite the roller coaster. And if you stayed on the roller coaster long enough, you stayed on long enough to actually see some fairly interesting returns over the long term. And you can see that 2 of the 4 have actually outperformed the market over that time frame, and it's actually fairly solid performance when you look at 4 companies basically turning in about 14% per year over the last 2 years, and then turning in a relative return of 1.8% on average taken collectively. So those are the 4 selections. Guys, do you have any comments or thoughts about the selections that we made, or want to chime in on any of that?
No, they're looking pretty good from where I sit. It was curious that we all picked healthcare that week, too.
Yeah, we took a little bit of grief for that, but again, that was kind of stocking the pile. I will say that, many people have questioned the Eli Lilly selection just in terms of it's not that exciting a growth company. Mm-hmm. Yet you've been true to your core and sticking with Eli Lilly. Mm-hmm. And you can see, and at least in our conversations, you continue to see a fairly promising pipeline and pretty well executing company there.
Yeah, it's hitting the patent cliff like many other companies, but it has a relatively interesting pipeline, and it's not averse to going and acquiring a pipeline whenever it needs it. And there are some drugs out there recently approved that are available for sale if it wants to try to augment its pipeline that way.
And in a theme that you're probably going to hear recurring a little bit here tonight, and no, it's not going to be about me doing beach volleyball. Ken's pick that night was Abbott Labs, another one that was kind of criticized a little bit within the community because Abbott Labs had been relatively stagnant for a while. You notice that Mr. Kavula checks in with about an 8% advantage to the Wilshire 5000 over the time frame so far. We're not going to talk about which one I picked, but you can generally find it by looking for the lower one. Definitely a bit of a rut. And
I wasn't going to say which one you picked, Mark, but I was going to point out I picked BRLI.
Well, yeah, and by process of elimination, and plus you guys get to pick on me a whole lot more in a few minutes, so go easy. But one of the things I would like to suggest, Cy, talk a little bit about BioReference Labs and how you found the courage to, for those of you that are not familiar with it, this company went from $21 down to, I believe, a price somewhere in the $7 range around Thanksgiving last year. Is that about right?
That's about right. I'm trying to remember if it got quite that low, but it was pretty close to that. It's when the shorts were hitting it hard, and that's one of those BioReference laboratory, something that I have just tried very much to steel myself to do, and have done it long enough now. Been investing nearly 30 years in individual stocks and trying to apply long-term BI and Nicholson principles. And just staying focused not on the price of the stock, either when it zooms, because actually BioReference, if I recall correctly, after this pick, jumped up pretty significantly.
Yep, that's right.
I was looking pretty brilliant for a while, and then it turned around and went the other direction when the bloggers started really trying to hit it very hard with a lot of what most of us felt at the time, once we started looking at it, was old news about a corporate officer who had done some less than reputable things. Then the company found out about it and did have him depart. I think, again, the bloggers criticized the company for not going after him civilly. And we're just saying something. There was a Barron's article questioning some of the company's investment underwriting when it went public 10 or so years ago. And all of those sorts of things drove the price down, but during that time I kept just looking at the numbers is the company, from a business standpoint, still doing according to what I had projected and what what the analysts manifest in the consensus analysis had projected, and the answer was yes.
Yeah.
And as long as that's happening, I'm willing to just keep buying into a company because it's our mantra that price follows earnings, earnings follow sales. Therefore, over the long term, price is going to follow sales, assuming they can profitably turn those sales into earnings. And BRLI has basically proven that out. Now, I will confess, it got a little iffy for me when they started getting into some of the ethical areas. That's the one a little question, because if you start questioning a company's ethics, then you have to start saying, okay, are the numbers that they're really putting out real numbers, that sort of thing. And so that gave me some pause, and I was trying to watch real closely and keep it very short leash there.
Never
again,
just one cockroach.
That's right, and so so that one, that gave me some dis-ease, if you will, and had to watch it. But again, the company kept sticking to their guns, and the numbers kept coming out legitimate, and so again, I just try very, very hard to focus not on what the price has done, but what the business is doing. And frequently, I mean, you mentioned stagnant on Lilly and stagnant in particular on Abbott. I tend to get more excited about a company when I see a price that's stagnant for a period of time when the earnings still keep going up steadily.
Yeah,
so,
up straight and parallels, not overrated. Well, thanks. We'll probably get a chance to tie some parallels into that when we talk about QSII here in a minute.
Mark, we're getting a question about quality rating. Could you go over that whole concept of quality rating? I'm sorry, wrong metric. Can you go over the issue of aphasia strikes the old? The accuracy rating once more for the people that are listening to us.
And I was all stoked up to do quality rating. I mean, I had that. It was beach volleyball. I was slam dunking that dude. No, the accuracy rating is really pretty simple. It's a matter of keeping track of the performance of the company. In the first case, they're Lilly. In the first line here, Lilly has generated a return of 17.6. Now that does include dividends. That's adjusted for dividends during a time when the market has gone up 12%. So therefore, it has outperformed the Wilshire 5000 by 5.5 percentage points per year. So we call that a win, and that's why you see a 1 over here. So this is basically, call it a W. So that's a win. In the case of Stryker, Stryker has done okay, but it has lagged a little bit behind the Wilshire 5000. So that's actually a, again, these are active positions, so they're not done. But for right now, it's behind. It's behind on the scoreboard. Might be a way to think of it. So 2 out of the 4 companies are ahead on the scoreboard. 2 out of the 4 are behind, and but all of them are actually in pretty good shape, especially taken collectively. So that's what the accuracy is all about. It's outperformance accuracy. Let's go ahead and move on and talk a little bit more about the broader picture, not just 1 month, but all 24 months when you add them up. Basically, we track this over time, that relative return. How well are we doing versus the market? This is our target range, again, as taught by Nicholson in our long-term community of investors. We're trying to get to a 5% per year number. And you can see that we're not quite there yet. And we'll continue aiming, trying to go higher. But as of 2 years, a couple of the components of our overall rating are doing all right. The first one being all of you guys. The audience itself actually has made 2 selections, and they've done pretty well, coming in at about 7%. So you guys can all take a standing cyber ovation and have fun. Keep bringing it. This happens to be Ken, and then there's a whole bunch of us down below here that are kind of clustered around that -5 range. And like we say, we think, again, keep doing the things that we know work, and we will be heading north. But again, there's a whole bunch of us clustered down there. I'm not going to name names, but mine's towards the bottom of that chart. And kind of in that spirit, because, you know, I believe it was Cy just said a few minutes ago, you made him a genius, or BioReference Labs made him a genius for a while. I know that if I keep doing the stuff that we do here, that someday again I'll get to feel like a genius, but I'm overdue. And this is obviously an interesting slide coming from the opening, for those of you that saw the opening session of the welcoming ceremony at the London Olympics. This was one of the scenes during that extravaganza, accompanied by the Shakespeare quote, basically that the aisle is full of noises. And I think that when it comes to the world of investing, as we were talking about a little bit in the green room beforehand, recessions deal us blows from time to time. Our metal is tested. One of the things that we've kicked around here in recent days is that some of our community favorites have really taken kind of a kick to the teeth. There's no gentle way to say that. And I thought what we might talk about just for a few minutes before we get into our stock presentations is, you know, again, what is our perspective? How do we handle that sort of thing? And here's one of those stories right here. It's a little bit fuzzy, but this is it's fuzzy probably because I probably screen captured through some teared up eyes. Quality Systems, and because I know a lot of us around here own shares in this company, and this company has literally gone from 50-something or approached 50 down into the mid-teens, closed somewhere around $16 today, and happened rather suddenly without any extremely obvious causes. And like we were talking about earlier, I would encourage anybody who's trying to at least understand or comprehend what's going on in this situation to take a closer look at the manifest forum in the stocks folder and look at a fairly elaborate discussion of what's been going on with this company for the last year or so. Now, I would kind of nutshell and capsulize the most recent few weeks and months as a soap opera of pretty epic proportions. And I'm referring to the proxy battle that's going on. One of the members of the board of directors of Quality Systems is being quite disruptive. And the stock price, it's been chosen here by a couple of us in just a few months ago, and we've seen a fairly significant price drop. So what I would encourage my colleagues to do is just kind of talk about how do we think about this sort of thing. And in that context, here is our weaker performing selections over the last 2 years. And the one up at the top is one that I don't like to talk about, but that's Research in Motion. I can do a whole session on how lousy I am at catching falling knives, and I'm trying to learn more as an investor about that. But Research in Motion, ticker symbol RIMM, has not performed very well. Quality Systems. What's the outlook of the group on how we interpret that situation? I know, Ken, you've been a long-time holder. What's your
I've been a long-term holder of this company, Mark, and my wife and I have been doing an awful lot of head scratching and soul searching and research. I've owned the company for more than almost 7 years now, and am still in the black as far as the company is concerned. And the question that she and I are faced with right now is, do we believe that the company is fundamentally stable, and do we add more to our holding, or do we sell while we're still in the black, even though we've lost a large amount of the profit? We did do some selling when Quality Systems took a plunge about maybe 9 weeks ago. So the holding isn't as large as it was previously, but it's an interesting quandary. And as I told you before the program started, this is the first time in a long time that she and I have been faced with this kind of a problem in real money, in terms of real money. So it'll be interesting to see where we come out with the whole thing. I don't think our process will be done for at least the next 3 or 4 weeks. But I think we do plan to have a decision by Labor Day as to what we're going to do with the stock. I see no reason to rush right now to do anything with QSII. That's at least my take on the situation.
Mm-hmm. And I'll actually step up and talk a little bit about the 5th or 6th one down, Strayer. I mean, back when we discussed this one back in that time frame, 2010, I'll never forget your words about, when you're faced with a oncoming locomotive in the world of investing, you have a lot of things you can do, and one of them is you can step out of the way. And that image kind of sticks with me. There are so many investing opportunities. In fact, our damsel Ann Manning also said that about a number of companies where, if you run into one of those situations where they just seem to have all this pressure coming at them from all kinds of different angles, you can simply go on to the next company and search for the opportunity, your next opportunity elsewhere. And I think that's a fairly important lesson. Hugh, any comment on Staples? I know you're going to bring that one tonight. Any going back to the August 2010 selection of Staples?
Well, it's a company that is suffering. I'll talk about it a little bit. It's suffering because of the headwinds left over from the Great Recession, and it's also suffering quite badly in Europe at the moment as well, where it was hoping, I guess, to get some growth. But this is a company that's just it seems to be held down for a while, just like Bank of America. And in my personal portfolio, I am accumulating both Staples and Bank of America, thinking of it as a 5, 10 plus year time horizon. But it's one of the good things about recessions, quite frankly, is if your outlook is long, I'm talking a decade or more, it is a great time to stash up on companies. And this recession, and I know we're in a recovery now officially, but it's not a very it's a very anemic recovery. So this recession for long-term investors is really a golden time to buy companies on the cheap. Staples being one of them.
And I want to repeat something you said there. I mean, first of all, Hugh, you have the honor of having a 3-time appearance on there with Bank of America, ticker symbol BAC. But did everybody hear he was talking about accumulating? And I've known Hugh for almost 20 years now and just been fascinated by the number of times when he will accumulate a company like a Bank of America, and he does so with such a long-term perspective. He's not looking at quarterly stuff, and he's not worried about temporary deterioration of return on equity and that kind of stuff. He's thinking, 2025, I think, sometimes, or more maybe.
Yeah.
Kind of a neat attitude.
Yeah, and I'll chime in on the last two down there that I think fit what you were just saying there, Mark. I think the market has about a 3 millisecond view of Cognizant Technologies perspective, and has driven the price down because it did take a pretty big tumble the last earnings report in the April time frame. If I recall correctly, it dropped somewhere from around that. I'm just trying to think. It may have gotten up to around, it was probably around that 70 or so, and dropped down into the mid-50s. It's since recovered a little bit from that. But listen to the words that the market, they beat market expectations. Their first quarter results beat market expectations. Their outlook was, and this was in April, they were talking about the month of April, in the last 30 days, we have seen a decrease in the rate of increase, we've seen a decline in the rate of acceleration of our earnings growth.
Yeah, that's enough to throw them into a quandary.
Yes. We have seen, in other words, our earnings are still growing. The growth
and
is actually accelerating, but it's accelerating slower over the last 30 days than it has been. And the market dropped roughly $20
wow.
as a result of that.
Yeah, that's one of those moment of truth moments where the CEO tells the truth and the market punishes him for it.
Yeah. So again, that's a perspective. And granted, Cognizant does have some healthcare and some banking clients. Those are two big areas that they're in, and again, those are two fearful areas for the market right now. They do have some European customers, and there's some concern there. So I mean, there are some concerns out there, but back to the time horizon you were just talking about. This is a dominant IT consultant out there, and if you're looking out 3, 4, 5, 10 years, they're going to do well. And again, even currently, their growth is increasing and accelerating.
Yeah, and this kind of comes back to Piero's comment in the green room. These guys are in a global recession moment, and to me, it's almost like the professional investing community, one, makes it worse than it is right now, and then two, they double down and they pretend that it's never going to end. And that's kind of the way these stocks get treated from time to time. So it's just an amazing thing. Well, let's spend the last couple of minutes of the first half of our program with the selections that make us smile a little bit more. Up at the top of the list, there are the top 2 or 3. There are Ken's selections. Apple, I think his only regret there was that he didn't come back and select it again the next month.
Yeah, for all 4 of them, Mark. Yeah, for the top 4. Yeah.
The top 4. Yeah, listen to him strut. Cool.
Well, Mark. But since we're bearing our souls to the public, I want to say that in the early stages of this experiment that we're dealing with right here, I was trying to be a home run hitter. I picked on that last slide that you had. My hogs pick is still probably down there near the bottom of the list.
Don't count them out.
I chose a couple of other things that I was trying to hit a home run, but I should have reminded myself repeatedly that I've learned over my relatively long history of investing that I'm a much better hitter of singles and doubles. I very rarely use sports analogies, but I think that one fits very well. That I do much better in looking for stocks that give me good steady return rather than give me dramatic large returns over short periods of time. So my style has changed dramatically in the last year and a half, and I've been going for much safer stocks and consequently doing much, much better.
It is fascinating because that is well documented in the transcripts of this, the roundtable sessions, where you basically said that, and you told us when you were doing it. That is so cool. Any other comments on any of these? I did notice, Hugh, that a couple of your Walgreens selections have bubbled to the top down there at the bottom.
Yeah, well, they finally got good news. They kissed and made up with Express Scripts. And I think Walgreens closed over at 36 today, did it?
I believe it did.
Yeah.
And then, Cy, any real hot ones on there? Notice Costco's on there. I know that's a Hugh pick. That's been around since the early days.
Well,
right. Well, of course, the BioReference roller coaster you referenced, BioReference has made both the top and the bottom.
Yeah.
So I mean, again, a matter of sticking with your methodology and picking it. And I noticed those are both the same date. I guess 2 of us must have picked.
Yeah, I believe
that month.
I believe the audience agreed with you that night. So I think that's an audience selection also.
Okay. Well, way to go, audience.
Mark, I like to point out, Mark, those 2 right above it, those 2 IPCMs that grew out of an industry study from the Mid-Michigan Model Club, an industry study that we repeated at our Burke on the Road this last spring, and then I brought the name to the roundtable twice. It really does help to study a stock with its peer group and to settle on one that has a compelling story as well as great numbers to go along with it.
Mm-hmm.
Absolutely. And I'll just kind of close out this session with pointing out that every once in a while I do get some on this leaderboard, and I'll call these a couple of Neogen type selections. If you've never heard of Neogen, that's a small company that's kind of a local favorite here in Michigan, but you can find small, high quality smaller companies like this is Landauer, and then this is one that everybody chuckled a little bit when I picked it. The name of the company is Home Away. They're in the vacation rental business. So both of those have worked out fairly well so far. In fact, Home Away was up well above 30, and they've kind of relaxed back here. But again, examples of 2 relatively young, smaller companies that with up straight and parallel working for them. So you can see a pretty good mix there, and I have been behind several of the the Walgreens selections. So with that, let's go ahead and launch into the stock part of our session. He would like to, he likes the rut that he's stuck in. He's going to stick in there with Staples.
Yeah. Staples is a company I picked last week, so last month rather. So I will pick it again. And as I said, I have been buying this company reasonably regularly. I like Staples. I think for the long term, it's a good investment. For the short term, it's facing challenges, and so it's not really going to be on the dance card of many of the people who tend to buy millions and tens of hundreds of thousands or millions of shares. But for now, at least, I think the stock price will be depressed, and it's a good chance to accumulate it. The projections up there come from Value Line. We'll touch on those again later on. But they have a compounded annual rate of between 29 and 37%. So if we move on to the next slide, just by way of background, as I said, I'm going to pick Staples again, and that's the Staples Center downtown here in Los Angeles. And on the next slide, this is from the website, pulled it off today. They didn't update the chart on the right, but when it was acquired last month, it was acquired at $12.24. It closed today at $12.74, up slightly, but the company is still, I think, in relatively good territory for more purchasing. So on the next slide, it shows what analysts are saying, and this is, again, from the Staples investor website. It's a tear sheet that they have for investors. The median recommendation is 2.5, so it's right in between strong buy and sell, hold, I guess. It has dropped slightly from what it was last month, as has the forecasted earnings. The consensus estimate was 23 cents 30 days ago. It's dropped very slightly to 22 cents, sorry, today. And then on the next slide, there's two slides here. One just shows the percent of institutional ownership. It's pretty high. The number of mutual funds owning the company has dropped by about 8 or 9. So everything is pretty stable here, the same as it was. We talked about it last month. And then finally, the next slide just shows who the big shareholders are. And these numbers are updated quarterly. So this actually hasn't changed at all since it was presented last month. You see Fidelity owns a big chunk. And so in terms of, go ahead.
Hugh, we're getting a question from John. He wants to know if you know whether Bain Capital still has any interest in Staples. It's been getting a little notoriety from its startup.
Yes, I know. I don't know. I don't know if they hold anything at all. When I looked, I didn't see their name appear. So if they own anything, it's less than 5%. So the company has had weaker than anticipated growth, and the stock price obviously reflects that. You could argue that that problem will fix itself as the economy repairs itself, and hence this is a good time to buy because presumably the stock price will go up once those revenues and earnings improve. The operating margins are flat. They're about 6.5%, and it appears that they will remain flat at least for the next few quarters. And as I said, business is both challenged and challenging in Europe right now with the strong headwinds from essentially problems in the Eurozone and, in fact, what appears to be a recession. Global sales account for about 20% of the top line, and a big chunk of that comes from Europe, where the company had been opening new stores. But that is all slowed down right now as problems in Europe surface. The company is continuing to acquire shares. It's probably going to buy back about 3% of the outstanding shares next year, and that's going to contribute, obviously, to EPS growth. And it has a strong balance sheet, and it did announce recently that it's going to be a launch customer for the Google Nexus 7, which I had to look up online to see what that was, and appropriately enough looked on Google, and that's it. It's a little handheld tablet. Essentially, we all know what these tablets are, and Google has a new one. And they're actually hoping to get a lot of the revenues later on this year from the sale of a competing entity, Microsoft, which is launching Windows 8. And I'm going to just recap quickly what we talked about last month. Useful to kind of drum it in, but it is the largest office supply store in its space with revenues of $25 billion. It invented the concept, it claims. It has almost 100,000 employees all around the world. 80% of the revenues come from business, and 60% of those revenues come from delivery, and that is the bright spot. Online services is the bright spot in the Staples empire. Only about 40% comes from the traditional stores that we all know and love. It does a lot of business through its subsidiaries, Staples.com and Quill, and it serves pretty much all of, nationally, about 95% of zip codes are served within a day, but it serves all medium and small businesses. It has over 1,900 stores. The average store is 22,000 square feet, and it has 9,000 stock keeping units, separate entities of inventory on sale. And as I said, it accounts for about 40% stores, 40% of sales. And the next slide just looks at international offerings, where although it only has 15% of the stores are international, they account for 21% of sales. And it has actually made some acquisitions recently. One large purchase in Europe, which they believe should contribute to the top line soon as things in Europe start to improve. That's Corporate Express, which is a Dutch-based company. But it's suffering right now, but it should contribute cash flow to the company moving forward. And if we look at the next slide, some of the things I think which are not widely known about Staples is that it's the #2 electronic retailer behind Amazon. You can see there that not quite half, but a large percent, 40% of its sales come online. And it serves 60% of the Fortune 100 companies. Then if we skip on to the next slide, we can start looking at some projections of the future. Here's part 1 of the stock selection guide. Doesn't look very nice recently. This company clearly has been whacked by the Great Recession. But, you know, as the economy recovers, so too will Staples, and that could be to our benefit. I've used a projected sales growth of about 6%. You will see in a minute that Value Line has a much lower figure of 3.5. And using the, I keep calling it the preferred procedure. I think it's the revenue-based earnings estimate, I think it's called nowadays. I come up with a growth rate for the bottom line of just under 5% per year, whereas the consensus estimate, or the historical, growth rate is about 7.5%. And again, I think this is fairly conservative because things will improve. And if we look at part 2 of the SSG, we can see that the pre-tax profit and sales and ROE don't look great, but they are improving, as you would expect. The company is digesting an acquisition that it made in Europe, Corporate Express, that it has actually rebranded, I think, as a Staples Enterprise. But things are improving on part 2 of the stock selection guide as well. And then if we look at part 3, where we're going to start looking into the PE ratios, we can see that the PE ratio really has taken a whack last year as well, as the company's earnings and sales earnings particularly dropped off a little bit. I actually then used that information in selecting a high and low. I selected a high PE ratio of 17 this time. I used 20 before, and I kept the low PE ratio of around 10. And that ends up giving a projection, forecasted high price of close to $30 per share. And I used 9 as an estimate of the low price. The share today is 12 and change, 12.74. But it gives an upside-downside ratio of close to 5 to 1, 4.6 to 1. So the company here looks to be a reasonably good buy. And then if we move on to the next slide, we can see that on the manifest side, Staples has a projected annual return of 16%, which seems reasonable, and it's certainly consistent with some of the other reports that I've been reading on things like TheStreet.com and Credit Suisse. But what's kind of curious is, and we'll see that on the slide that follows, is when we look at, unless, did you want to comment on anything there, Mark?
No, I'm good. I mean, ours is a little more consistent with Value Line, probably placing a lot more emphasis on that plateau in your visual analysis.
Yeah. So if we skip on to the next slide, we can see that part 5 of the SSG shows that the projected return that I get of about 15%, if we use the average PE ratio, is kind of close to the manifest par of 16%. It's in the ballpark. And then finally, in the slide that follows, Value Line has the top line growing at 3.5% as opposed to the 6 that I used. But they have a rather aggressive earnings growth of close to 10%, whereas, as we said earlier, when I did the revenue-based forecast, it worked out to be just under 5% using a stock selection guide. For 2015 to 17, they project a price range of 35 to 45. My high, if you remember, was 29.9, which is actually lower than Value Line's lowest projection. So just from a number of different sources, this growth rate that is projected for the company seems reasonable, and I think it's reasonable to expect that even if the company languishes a little bit into the future, it should more than double within the next 5 years. And finally, on the next slide, if we're just looking at where the company has been, looking at the price on the left and the projected annual return on the right. You can see over time the company has kind of visited highs and lows, but now in recent price, it's in not a bad spot at all.
Hugh, we're getting a couple of folks that want to know if you would care to comment on Staples versus its two major competitors, Office Depot and Office Max.
Yeah, I think Staples is in a stronger position than both of them. If you look at, I'm just looking at what happened there with the font up on the top. But if you look at the financials, you could argue obviously that Office Max or Office Depot is maybe slightly better. But Staples is the 800-pound gorilla. I mean, it has the online business wrapped up. And I think going forward, it is, if you want to say that this industry is really in a bad spot right now, Staples is clearly, to me at least, the best of the bad bunch. It's the one that really stands out. There have been rumors, and these have been reported by some analysts, that Staples has made overtures towards one of those two, and I can't remember if it's Office Depot or Office Max, to make an acquisition. And if you recall, I think about 10 years ago, Office Depot and Office Max tried to merge, but it was knocked down by the Justice Department, if I recall correctly. The environment since then has changed, and maybe there is an opportunity whereby an acquisition could be made. But I think Staples is in better shape than its competitors. And as usual, the fools on motleyfool.com tend to be very upbeat about the performance of the company. As I think we talked about last time, the fact of the matter is that this group is really self-selecting, and those that tend to want to say good things about a company probably do. Generally, if you don't like a company, you're going to stay away from it. So chances are that the folks here that claim it's going to underperform are people who know the company quite well and have followed it for some time. But I've noticed on the Motley Fool that you always tend to get an overabundance of people with nice things to say about the prospects for the company. Yeah,
and just to reinforce that, at 93% that you can see here, that's actually very average.
Mm-hmm.
Because that's the way that everybody should think about that in terms of the sentiment. That's actually a very average sentiment.
And these are for the All-Stars as well.
Mm-hmm.
So, in summary for Staples, I mean, it has had a rough recent quarter, so hence the stock price declines, which is good for long-term investors. It is still digesting a purchase that it made recently in acquisitions, so part 2 of the SSG is messed up a little bit. It is a leader in its space, and it is expanding overseas, although it has quieted that effort recently as headwinds in Europe kind of push it back. I believe the company will recover as the economy does. The economy, we are in recovery mode right now, but it's a kind of a slow and anemic recovery. But as things start to push up more aggressively, Staples, I think, will be a beneficiary of that. So I sit here, I select Walgreen because that's just completely out of habit. In fact, I still select Staples.
Am I going to need to go
I'm
back?
not selecting Walgreen anymore. Walgreen has been very good to me.
It's another good rut to be stuck in.
Yeah.
By the way,
Am I going to need to go back and fix the poll again, Mark? What do you think? Huh?
Could be. I will point out that according to Seeking Alpha, Office Depot is the acquisition target by Staples.
Well, that's right. Yeah. It's a rumor, of course. But
yeah, it's good stuff. Well, thanks, Hugh.
Good. So you can staple that to the portfolio.
Okay, I will do so. It'll be easy. Rim shot. How do we do rim shot around here? All right, Ken, do I need to switch control to you for Microsoft? No, it sounds like you're doing it yourself.
Yeah, I'm going to go over to my screen real quickly if I can here,
Okay.
Mark. And I want to show people how I came to Microsoft, because there's not too much that I want to actually say about Microsoft except maybe comment on its most recent report for the end of the 2012 fiscal year. I started my search by going to the homepage of Manifest Investing, and right here under Published Dashboards I clicked More. And I get a list of a lot of published dashboards, and if I scroll down I found the roundtable on the list, and I went to the roundtable and I put them in par order. These are the stocks that we've chosen. It tells you on top how many times we've chosen various stocks. 7 times for Walgreens up there, if you notice. And I kind of like to look at the border, the place between the top of the sweet spot and the too good to be true stocks. That's what the yellow coating means, that it might be too good to be true when you get more than 10 points ahead of actual MyPar value. MyPar 9.2, remember that's the median return for all the stocks in the universe that Manifest follows, and the sweet spot is 5 to 10 points above that, so 14.2 to 19.2. So I'm examining right at the boundary right here. And when I did this examination earlier today, Microsoft was the first stock directly below the boundary. I noticed that Microsoft and AFLAC have traded places this evening, but I feel that Microsoft is a very respectable candidate at an 18.9% return. So the next thing I did was I went to my SSG. And here's what I got when I downloaded data, and to be honest, on first glance, I was quite taken aback by this earnings information right here. So I went to the website, make sure I get the right one here now. Well, I've lost the website. How do you like that, folks? Let me see if I can get the website back real quickly. I went to Microsoft Investor Relations, and right here is where I hit and there's a press release for the full year revenues that I can as soon as my computer loads that I can hit right here. And I took a good 45 minutes and read and tried to digest this press release. I would urge you, if you're studying Microsoft, to look at what this press release says about the most recent quarter, and that's the one that ended June 30th, and that also ended the fiscal year for Microsoft on June 30th. But I'd look very carefully at the GAAP numbers. Those are the numbers you see reflected in your Morningstar data coming from Better Investing, and compare them to the non-GAAP numbers, and then try to understand, try to read what they're saying contributed to the differences between the two sets of numbers. Essentially what's happening is, in this final quarter of 2012, Microsoft chose to write off about $6.2 billion right here for the impairment of goodwill, and that goodwill came from an acquisition that they made about 2.5 years ago of a company that was supposed to give them increased presence in web processing, but in fact didn't work out the way it was supposed to. If you're not sure what goodwill means, if you're not sure what impairment means, I would urge you to do a little bit of study, do a little bit of research, look up in some of the financial dictionaries these terms, and then try to put your definitions along with what the press release is actually saying. It was certainly a lesson for me, and if I were to add back that one-time charge-off of goodwill, I wouldn't see this dot moving so much in the direction that it's moving right now. I did put in analyst estimates for the next 2 years going forward, and I noticed that they were pretty much on trend with my call coming off the end of the trend line right here from Microsoft. My sales call for Microsoft is about 7%, and using the preferred procedure, I came up with about an 8.5% growth in earnings. My SSG shows that margins have stayed relatively even, although there was some decline going on right here year over year. Again, I'd want to reevaluate these numbers, and I might be plugging in either value line numbers once they come out, or I might be trying to manufacture my own set of numbers. You can change numbers in the data set by clicking on annual data and then plugging in your own choices for values down here. And I might be making an attempt to plug in non-GAAP numbers as I move forward for that 1 year. I am waiting for Value Line to see if they've normalized their numbers to non-GAAP numbers. I've decided that I kind of like the averages as they stand for this company, and I went with the high and low averages of 16 and 10.9. That gave me a pretty decent upside downside, and it gave me a return lower than the manifest return. So of course I wanted to see why that was happening. Frankly, my average PE is almost exactly the same as manifest average PE, but I noticed that my call on growth, sales growth going forward, was considerably lower than Manifest's call. Manifest is calling for about 9.5% growth rate. In fact, I think I can show you that for, no, I can't. I was going to show you that for Manifest Investing. Yes, I can. I'll go up here to stocks and real quickly over here do Microsoft.
It's interesting that Echo is at the top of that chart there.
Yep, it is. And I'm getting a sales growth of 9.5. The last thing I want to show you is that not only did I come up with Microsoft through the use of the dashboard from the roundtable, but I also ran a real quick screen that I like to run. Manifest allows me to do real quick screening, so I put in a minimum of the bottom of the sweet spot. That's that 14.2% growth right there. A high quality of 65 or better, and then I asked for very high financial strength numbers and earnings stability numbers. This is the balance sheet, and this is how straight the lines are for earnings on the SSG itself. And I hit search, and again I like to kind of check out what's happening right at the border, and lo and behold, Mark's choice came up right below the border and my choice came up right beneath his. When I did this earlier today, Microsoft was actually the first one right below the border, and Echo was the first one right above the border. So there's a little bit of movement day to day, but there's a couple of different ways I arrived at the company. It pays a nice dividend. I see nothing to derail what the company is doing. I like the fact that it's going to try to be competitive in a number of areas. So I don't see anything wrong with putting some money into Microsoft today, and that keeps it short enough to make some room for whoever's next. Okay.
All right. Well, thanks, Ken. You should go ahead and switch it back.
I will do that.
And then you can tinker away and get ready for the poll, I guess. So with that, speaking of guys stuck in a rut, let's go ahead to go to the guy in Atlanta who likes the home team, AFLAC, again this month.
There we go. That's right. You were bragging on your Michigan picks earlier, so I'll stick with the Georgia pick with AFLAC this month. Also picked it last month. The stock's up a little bit in price over the last month, but not too much has changed, although they did release second quarter earnings between last month and this month, and I'll mention that very briefly. Of course, I think everyone's quite familiar with AFLAC. What they do is sell supplemental life and health insurance. Their primary business is in Japan. About 75% of their revenues come from Japan, and the primary product in Japan is supplemental cancer insurance. The higher growth market for AFLAC is the United States, although it's not a high growth area where they are, again, selling supplemental health insurance policies largely through employers, and up until the last couple of years sold it primarily to individuals through their employer. Now they're seeking more business through brokers and encouraging employers to offer it as part of their employment package. So that's very quickly what AFLAC does. You may recall last month I did something very similar to what Ken just described, that being going to the going to the round table dashboard, looking for the top of the sweet spot, and AFLAC was there. Actually, when I did that this month, they were just above, just into the yellow, which was close enough for me, and it was really between AFLAC and Teva, and I just felt a little desirous of being again more in a rut for 2 months in a row. And quite frankly, I'm in a contrarian, not contrary, hopefully, mood, and just think that again, the financials being a little overly beaten up and a little bit too much attention to Europe. You could see AFLAC generally up straight and parallel, a couple of hiccups in sales and earnings there on the chart. The trends are certainly solidly growing. And again, kind of our quick double check on potential being the value line, low return, and that is pretty much what it is today. The value line report was issued in the last couple of weeks, and it I think is at a price of 42 something, which is right in line with the current close for AFLAC. So that's pretty much a real value line projection right now. Then I jumped on over to the next slide, which is my judgments. Not much different again than last month. The only thing that's changed is the price has increased a little bit. You see the three judgments there. The first judgment being growth in revenues. For financial companies, we use book value. So that's projecting a 10.7% growth in book value. That happens to be the manifest number. Value line's number is actually 13.5%. If you just take their raw number unadulterated, I am comfortable with the 10.5 for a reason I'll mention in just a second. Return on equity, you can see there's a chart on that. That is our profitability measure that we use for financial companies. That top chart shows the 10-year history for AFLAC's return on equity. You see that it's leveling off a little bit above 20 the last couple of years, although for the trailing 12 months it's 17.1% due to some write-offs that they're taking against their portfolio, and again, just being relatively conservative, because that's what the question mark is the investment portfolio, particularly as it relates to Europe. I chose to not use the 20 returns on equity. Also notice those are actually 2010, 2009. If you do factor, if we showed 2011, which just hasn't made that chart, you would see it down a little bit toward that 17. I chose just to keep it the same. And then the PE forecast, again, right around where it has leveled off the last few years, which is 10, which is slightly above where it is now current. and then that led me to a stock projection price of 83.77. There, 84, and total return of 16.6. Since again, AFLAC's generally familiar with to everyone, and we talked about it in a little bit greater depth last month. The main thing I wanted to point out is just mention what there were some questions about last month, and again, what everybody looks at in questioning AFLAC's prospects going forward, that primarily being their exposure to pigs, pigs with 2 eyes, Portugal, Ireland, Italy, Greece, and Spain. Currently, let me jump over to my notes here so that I can give you the exact numbers. Actually, I don't have the percentage. I believe it's about 5% of AFLAC's book value portfolio is invested in those 5 countries. Actually 4, but, well, could be 5 at book value. No, I take that back. They have no Greek debt. That was the book value I was looking at. They have about $5.6 billion in book value in pigs exposure. However, they have written that down through impairments to just $1.9 billion. Now that $1.9 billion is somewhat of concern to Morningstar, and they point out that it is a significant portion of the company's shareholder equity, and it is a fairly high share of shareholders' equity. However, what I did, since we are basing our growth rates for financial companies on growth in book value, which is just shareholder equity divided by earnings per share, divided by shares, I took a look and I said, let's assume that the entire $1.9 billion that AFLAC is currently carrying this the pigs securities at, that they're carrying it at $1.9 billion, significantly below the book value, which is the face value in most cases for these sorts of securities, what AFLAC purchased it at. They, if you just write off that whole $1.9 billion, that would reduce Value Line's projected book value growth from 13.5% to 12.5% over the next 5 years. When I ran it through a stock selection guide, it reduced my earnings per share growth by just a little over 1%. If you actually carry it through sales, which would be a more accurate representation of it, of the impairment charge, since actually this is carried through investment income, which appears on the revenue side if you don't use book value growth as your revenues, it would result in a 0.1 percentage point, or 1/10 of a percentage point reduction in growth over the next 5 years, which flowing through to earnings per share I calculated would be 0.2 of 1%. How much longer can I take to say it? Certainly $1.9 billion is a lot of money, but for a company the size of AFLAC, it would essentially be one flat year and not a whole lot of significant impact on their 5-year growth rate. So I think that it's overblown. That's why I did choose to go ahead and take the lower book value growth that you see there, as well as the more conservative return on equity, saying that, okay, let's assume they haven't yet seen the worst of the European debt and they have to take a little bit more of a hit. Let's factor that in, and you still are looking at a 15% plus return at 16-17%. So that's why I picked AFLAC.
Well, thanks, Si. That's actually I was just going to make a point that that's a really good demonstration of a worst-case scenario. Go ahead, Ken.
Si, we have a question. You're using proxy values, I think, because this is a financial company, but we have a couple of folks that are confused by, they think that you've equated return on equity to net margin, but in fact it's a proxy value. Am I correct?
That is correct. The more general way of expressing what we look at, whether you're using manifest specific tools or the SSGs, you're looking at a company's growth and its profitability. For non-financial companies, growth is measured by manifest, and again on this stock selection guide, by sales or by revenues. For financial companies, manifest uses as a proxy for sales growth in book value. Then for profitability, again, manifest uses net profit margin as the profitability measure, and for non-financial companies, and for not financial companies, as you correctly stated, Ken, the proxy for the profit margin or profitability factor would be return on equity, which is that profit on the book value that we're using as the proxy for revenues.
Thanks, Si. Susan, you wrote the question, and if you have a follow-up question, if you write it in the question box, I'll try to get it asked, okay?
Okay. Thanks again, Si. All right, I'm going to be the only one of our group that is bold enough to go where no man has gone before tonight, and that's outside the portfolio. I thought I would share a quick look at what we put out in our weekly message every week, generally sometime fairly close to Monday morning, posting this in the Manifest Forum. It's what we call our panoramic screen. And simply, it's a group of companies that qualifies with a manifest rank greater than 99 and a financial strength greater than 70. That would be roughly a B++ equivalent. The manifest rank is a combination of projected return, so the return forecast in combination with the quality rating. So what we should see, and we do, a fairly strong collection of companies with strong fundamentals in terms of quality and par. And again, that we rank them, score them, and do them from top to bottom. What we basically do on the panoramic screen every month, and this is an experiment, it's a work in progress, is we then go through this list of companies. All of these are fundamentally sound. They might be under pressures in various different ways, could be things going on, but long-term, fundamentally sound. So then what we want to take a look at is the companies that are currently bearish. We might want to give them a little bit less attention right now. And you see the orange bear claw there. The ones that are in orange. Notice the number of information technology companies that show up in the orange color coding. Again, those have bearish sentiment right now. So I just kind of say, oh, they're okay, but maybe I want to study something a little bit stronger. So if you take a look at the companies that are in the neutral or the yellow range, you've got your Cisco's. Again, a lot of information technology, an apparel retail company there, Fossil, electric utility. Here's Hughes Staples. Again, I think Hugh demonstrated that they're in kind of a mixed breed area, or mixed emotion area, if you want to call it that. Certainly a deeply undervalued opportunity. And then last but not least, this blue bull is a reminder that, well, some of these companies, there's actually bullish sentiment right now. So I want to shop towards the top of the list, much like Ken and Si talked about. And the company I decided to take a closer look at tonight is Echo Global Logistics, ticker symbol ECHO, ECHO. You can see it scores pretty well stacked up against the other companies in the portfolio. What you're looking at here is just kind of a set of notes that I gathered while spending time at the investor relations section of the Echo website. It's real easy to remember. It's echo.com. And what was interesting is while I was on the page, I didn't find any like investor relations presentations or that sort of thing. So I dropped an email to the Vice President of Investor Relations. Within 30 minutes, she responded to me with a deck that we will be sharing in the Manifest Forum. But in going over that deck and some of the stuff that is posted there, I just kind of wanted to hit some of these major themes which kind of capture my attention. This is a company involved in the transport of stuff. They basically work with trucking and shipping companies and companies that basically want to move stuff around. They're web-based, and they basically are what you might call an optimizer. They basically could be characterized as a kind of an Expeditors International, or I tend to think of them, again, just coming at it from this level, as kind of a matchmakers. They literally are matchmakers. And their specialty revolves around this software, which is web-based. We kind of like that here at Manifest. And they have this really powerful scalability. We talked about that a lot when we talked about Mercado Libre. They do business with a whole bunch of people who move things around. That's kind of cool. And in recent years, it's not a very old company, we'll see here in a few minutes, they have less dependence on their largest customers. That's also a very powerful thing. Another thing I know that many of us around here like, especially during difficult times, they have very little or no long-term debt. They're also a trucking company or a logistics company that doesn't happen to own very many of their trucks, if any. They're not an asset-based company. And what that's kind of cool, and then I want to come right over to this, basically they behave like almost an investment club type mentality in the business that they operate. And the concept is pooling. And that's something that's very familiar to all of us, pooling to share resources and optimize cost reductions. And one of the neat things is because they aren't asset-based with a whole bunch of fixed assets, when they have to adjust to fluctuations in the marketplace and the economy, they can move around. They can be very flexible and responsive to economic-driven needs, so they can deploy as required with their general administrative stuff. It's a big market, $134 billion estimated market, estimated to grow even through the recessions at 2 to 3 times GDP. We really like this one when we're talking about smaller local companies. They're out of Chicago. I don't know if they're currently hiring, but they've recently been hiring. And again, some companies that we respect a great deal, Charles Robinson, Forward, and Expeditors, they're in the kind of the same league, if not directly competing against some of them. They're in the same type of services, certainly same flavor of services. So all this stuff kind of added up to, gee, I think I want to take a closer look. Here's a closer look. Again, relatively young company, came out in an IPO a couple years ago, so they do not have a long operating history. The company has been in existence for a few more years than that before when they came public, but you can see a fairly decent trend beginning to emerge. Again, one of the caveats we always take away from this situation is they really did not have a whole lot of visible operating characteristics during that recession, so we might want to go back and dig in a little bit deeper to see what happened to the company during that recession before the public offering. But in general, you can see a fairly favorable forecast on both the bottom line and the top line. And again, a stock price that's been relatively channeled or relatively flat. And again, as I said about 45 minutes ago, anytime you have an earnings trend that is strong and seems to be headed north and in the right direction, combined with a stock price that's stagnant, at some point it becomes interesting. Again, relatively small company, still under $1 billion in sales, 20% growth rate possible. Here's a close look at the profitability of the company as measured by their net margin, including a couple years of operating results. Again, you'll see they come in right around 2%, a couple years of analyst estimates, and again, the analysts are optimistic that they'll at least be able to maintain, if not enhance, their overall profitability a little bit going forward. Perhaps some of that scalability coming into play. Here's our point of view summary, just to make the point that they're not dramatically widely covered by the value lines, the Standard & Poor's, or the Morningstars. We do get a few tidbits of information to compare against some of our assumptions, but based on the stuff that we'll talk about here, the 20% growth, the 2% profitability, and a PE somewhere in the 20 to 25 range, we are talking about a company in the high teens when it comes to the return forecast. So that's pretty cool. Really strong, high quality, excellent rating there. Again, the lack of debt, any real debt comes into play. Value Line sees them as a B++, which is pretty strong for a relatively young, smaller company. You can see the Morningstar gives it a B. Now that's a B. You got to put that in context. They only have 5 grades, A, B, C, D, and F, and that's the second highest rating. So not bad, especially for a fairly young company. You can see that the PE, somewhere in that 20 to 25 range, compares pretty favorably to Value Line, Standard & Poor's, and Morningstar. And you can see where we have a strong buy outlook on the company based on the stuff that we looked at fundamentally and the bullish sentiment. Morningstar is a little bit more reserved on the company, actually has it at a hold. But the company does have a decent relative strength. It's down in the lower half of the spectrum. One strike against it, probably the only weak chink in the armor here tonight, is the Motley Fool sentiment rating. It's at 86%. You heard me say during Hugh's presentation on staples that 93% is average. For whatever reason, the people who follow it at the Motley Fool are a little bit less optimistic about the company. But again, that's a relatively small dent in the armor. I believe there's only 14 All-Stars tracking it, and 12 are positive on the company. So with that, we'll just go ahead and add Echo to the portfolio. Probably take a little bit closer look to see how it performed during the most recent Great Recession. But interesting company out of Chicago, worth digging into. I'll have that deck provided by Suzanne in Investor Relations on the Manifest Forum here within a couple of days. And would welcome any questions or any follow-up on it in the forum. And with that, we did run a little bit longer tonight. We're coming in at 9:45, so I think we'll have a short Q&A. In fact, Ken, why don't we just go ahead and officially shut down and then stick around for another 5 or 10 minutes? Is that okay with you?
Before we do that, Mark, I've launched the poll.
Okay.
Let's give our audience just a real quick chance to choose the stock they think they would add to the portfolio from the 4 choices we've made. If you could select one, AFLAC, Walgreens, Fossil, or Staples, and of course I have the wrong choices up there. So this poll is going to not work tonight, Mark. I messed it up. I'm sorry.
Oh, you grabbed the wrong one out of the pile?
No, I just messed it up. Okay.
Well,
I'm going to.
It's an opportunity for a bunch of people to jump in the rut with you.
Or with I.
I'm going to close that. I'm awfully sorry, folks, and we will have our poll ready to show the next time. Okay, I'm awfully sorry.
Well, maybe I'll do one in the forum just for kicks, just to get the audience involved in the Manifest forum too. All right, not a problem. We'll get that fixed.
Okay, Mark, also, Mark, we're having a number of people, after we officially close down, could you show folks again where you're getting the bullish, bearish sentiment from?
Absolutely.
Okay, all right. So
all right.
if there's nothing else to contribute, then we want to thank everybody for coming to this session of the Mid-Michigan Roundtable. We had a really nice audience for a warm summer evening, and we hope to see you all next month. We can announce our date for next month, folks. We will be meeting at the Roundtable on the last Monday in August. That's August 27th at 8:30. Mark your calendars, and the invitation will be coming to your email box soon.
Thanks, everybody.